Welcome back to Stock Predicator, where we break down the investing world so you can make smarter financial decisions. Today, we're diving into a topic that sparks endless debates among investors: dividend stocks versus growth stocks. Which one should you really be putting your money into? The answer isn't as simple as you might think, and today, we're uncovering the truth that most investors don't know. First, let's start by defining what we're talking about. Dividend stocks are shares of companies that pay a portion of their profits directly to shareholders, usually in the form of quarterly or annual cash payments. These are often companies with stable earnings, like utilities, consumer staples, or large financial institutions. The appeal: they provide regular income, which can be reinvested to compound over time. On the other hand, growth stocks are shares of companies that reinvest most or all of their earnings back into the business to fuel expansion. These companies rarely pay dividends, if at all. Think tech giants, biotech firms, and emerging companies in high-growth sectors. Investors in growth stocks are banking on the stock price appreciating over time, rather than getting a steady paycheck from dividends. Now, most beginner investors assume that dividend stocks are safer and growth stocks are riskier. While there's some truth to that, it's not the full picture. Safety and risk are relative, and they depend heavily on your investment strategy, timeline, and personal goals. Let's take a deeper look at dividend stocks first. One of the biggest advantages of dividend stocks is income stability. Even if the market is volatile, you can rely on dividends as a source of cash flow. This is especially attractive for retirees or anyone who needs passive income. But there's more to it than just the cash. Dividend-paying companies tend to be well-established, profitable, and financially disciplined. They often have a track record of weathering economic downturns. That means less volatility in your portfolio compared to growth stocks. You're less likely to see the wild swings that come with high-flying growth companies. Another hidden benefit is compounding. If you reinvest your dividends, you're buying more shares over time, which can significantly boost long-term returns. Some studies suggest that a large portion of the stock market's historical gains actually comes from reinvested dividends, not just stock price appreciation. However, dividend stocks are not without drawbacks. Since these companies are usually mature, their growth potential is limited. You might see slow stock price appreciation, and during periods of inflation or market rallies, dividend stocks can underperform compared to growth stocks. So while you get stability, you may miss out on explosive gains. Now, let's shift to growth stocks. These are the companies that excite investors. They're innovating, expanding, and capturing new markets. Because they reinvest profits rather than pay dividends, growth stocks offer the potential for massive capital appreciation. The appeal is clear. If you pick the right growth stock at the right time, the gains can be life-changing. But here's the catch: growth stocks come with higher risk. Prices can be extremely volatile, and if the company fails to meet growth expectations, the stock can plummet. Investors need a strong stomach for ups and downs and a long-term horizon to ride out volatility. One of the most misunderstood aspects of growth investing is that it's not just about picking hot stocks. It's about understanding the company's potential, market size, competitive advantages, and ability to scale. Growth stocks can outperform dividends in the long run, but they require patience, research, and a tolerance for risk that many investors underestimate. So, which is better, dividend stocks or growth stocks? The honest answer is, it depends. Your choice should align with your financial goals, risk tolerance, and investment timeline. Let's break it down. If you're seeking passive income, stability, and lower risk, dividend stocks might be the way to go. They can provide a predictable cash flow, especially if you reinvest dividends to accelerate compounding. Retirees often lean heavily on dividend stocks because they need income without selling shares, and they want to minimize exposure to market volatility. If your goal is capital appreciation and you're willing to take on more risk, growth stocks could be more suitable. Younger investors with a long investment horizon often prefer growth stocks because they can endure volatility and benefit from years of compounding stock price gains. But here's a truth most investors overlook: you don't have to choose one exclusively. Many successful investors build a balanced portfolio that includes both dividend and growth stocks. Dividend stocks can provide stability and income, while growth stocks fuel long-term wealth creation. This combination can smooth out returns and reduce the emotional stress of market swings. Let's talk about tax implications, which is another aspect often ignored. Dividends are typically taxed in the year you receive them, depending on whether they're qualified or non-qualified. Growth stocks, on the other hand, allow you to defer taxes until you sell the shares. This can be a big advantage if you hold growth stocks long-term, as you're essentially letting your money compound tax-deferred. Another factor to consider is sector exposure. Dividend stocks are concentrated in mature industries, utilities, consumer staples, and financials. Growth stocks often dominate tech, biotech, and emerging industries. This affects diversification and portfolio risk. A diversified portfolio might include both to balance stability with growth potential. Now, Let's bust some common myths. Myth number 1. Dividend stocks are boring and slow. While it's true they may not skyrocket like some tech stocks, reinvested dividends can lead to extraordinary wealth over decades. Many of the world's most successful investors, like Warren Buffett, rely heavily on dividend income as part of their strategy. Myth number 2. Growth stocks are guaranteed to make money. Far from it, many high-growth companies fail, and investors can lose large portions of their capital. Careful research, risk management, and a long-term perspective are crucial. Myth number 3. You should always pick one over the other. As we mentioned, a blended approach often works best. Diversification across income and growth can help weather market cycles while still capturing upside potential. Here's a practical tip. Consider your portfolio like a meal. Dividend stocks are your protein, steady, reliable, and essential. Growth stocks are the spices, high potential, exciting, and transformative if used wisely. Too much of one or the other can make your diet unbalanced. So, how should you start? First, define your goals. Are you investing for income, retirement, or aggressive wealth creation? Next, assess your risk tolerance. Can you stomach large swings in stock price, or do you prefer stability? Finally, build a plan. Allocate a percentage to dividend stocks for stability and income, and a percentage to growth stocks for long-term growth. Adjust this over time as your goals evolve. Another tip: don't ignore the psychological aspect of investing. Many investors panic during market downturns, especially if they're holding volatile growth stocks. Dividend stocks can provide a buffer, giving you confidence that your portfolio is still generating income even in rough markets. Let's also talk about historical performance. Over long periods, dividend stocks have delivered consistent returns, sometimes outperforming growth stocks when accounting for reinvested dividends. Growth stocks, however, can deliver extraordinary gains during bull markets but can also suffer huge drawdowns during recessions or tech bubbles. Understanding historical cycles helps investors set realistic expectations. Lastly, remember that investing isn't about chasing hype or picking the next big thing. It's about disciplined allocation, understanding risk, and leveraging compounding over time. Dividend and growth stocks both have their place in a well-rounded portfolio. To summarize, dividend stocks provide income, stability, and long-term compounding benefits. Growth stocks offer high potential upside but come with higher volatility and risk. Most successful investors don't choose one exclusively, they combine both based on their goals, risk tolerance, and timeline. Understanding the differences and the trade-offs is the key to building wealth intelligently. If you've learned something new today, hit that like button, subscribe to Stock Predicator, and turn on notifications so you don't miss our weekly breakdowns of investing truths most people never hear. Before we wrap up, here's a challenge. Review your current portfolio and identify how much is allocated to dividend stocks versus growth stocks. Could a better balance help you reach your goals faster? Take note, and make adjustments thoughtfully. Your future self will thank you. Investing isn't a sprint, it's a marathon. Whether you lean dividend, growth, or a mix, staying disciplined, patient, and informed is what separates successful investors from the rest. Thanks for watching Stock Predicator. Remember, knowledge is power, but action is wealth. Make smart choices, stay consistent, and let your money work for you.